either voluntarily or not so voluntarily, and they might have retirement accounts that they left behind. And so that's a big thing right now. I want to help people roll that stuff over so they have control of it, so they know how it's invested. And a lot of the times, an employer's account wasn't invested specifically for you, anyways. It was just general. May not be the right investments for your goals. So I can do all of that. Never costs anything to talk to me. So I'm also doing hopefully some financial needs analyses. Those are also our free services that the company offers. So anybody that knows anybody who's looking for those things, send them my way.
Thank
And
you.
I'm interested too about some of the changes in the taxes.
And
So
Laura, you bring up a good
optimize our our deductions.
Right. And with this hot, real estate, with this hot stock market, you want to make sure that your money is not languishing somewhere, like control.
Exactly.
Control.
No, and that's a big deal. There are like trillions of dollars sitting in bank accounts.
Right.
You don't want your money in a bank account right now.
No. Thank you. Awesome. Sherry Damon, welcome.
Hi, I want to apologize for my lighting. I'm away on vacation and I don't know where all the lights are yet. So it's a little dark. I'm sorry. Yeah, I'm so excited to be here. I am the founder of a Foundation for Learning and Inspiring Health and Healing. We abbreviate it FLY, which is a very crazily busy, growing wellness and therapy practice. I have 4 dietitians, 4 therapists, an assistant. We do all kinds of different levels of equine assisted therapy, animal assisted therapy, holistic therapy, mindfulness teaching, yoga therapy, really kind of a full practice. And we treat a tremendous amount of eating disorders. And that's really what we have a huge reputation for that, as well as other mental health and wellness issues. And we have when we're not in a pandemic, we have an office in Marshfield and in Mashpee, and I'm building out in Pasadena, California. So, but right now we're all virtual, doing everything, all of our groups and everything virtually. And I think most of what people have brought up from a tax standpoint is similar to what I'm looking for, where we've grown so much, just trying to make sure I know what I'm doing in terms of maximizing deductions, record keeping, all of those pieces.
Awesome. Well, welcome. What you do sounds really interesting. We'd love to have a conversation with you. I think it'd be something to talk about what our members might be interested in, because we're really all about, we're about the business piece, but if we're not healthy and well, it's hard to do well in your business, right? That's the messaging always.
Absolutely.
Thank you for joining us today. Deb Gashel, hello.
Hello, everybody. Deb Gashel from Message Artist. Honestly, I think several of you have already kind of put forth what I'm interested in too, just sort of what's changed. I am still currently running my business as a sole proprietor. That's probably going to change in the next year or two as I grow. But so I'm basically looking for anything that I have to, be aware of in that arena. Deductions for the business, the charitable stuff, that would be very interesting because we have actually given quite a bit away this year. So just pretty much everything everybody's already said. So thanks.
Awesome. Thanks, Deb. Patty, nice to see you.
Well, nice to be back. Hello, everyone. I was a member a couple of years ago, and I did some research and development, and I'm back again. So happy to be on board. I really wanted to do the lunch and learn today because I'm in my 60s now, and retirement is always on the mind, and how do all of these things kind of come in together and play into things. I have an IRA. Should I be taking some money out of that and investing in gold or silver, and the little questions like that. So start with getting the taxes right, and I think we can have more success after that. So thank you, Helen. I'm happy to be here.
My pleasure.
Well, Patty, you bring up a good point, because sometimes, they always say don't Google your symptoms. The other thing not to Google is, what should I be doing with my money? Because I think there's so much information out there. And if there's one takeaway, it's find a good, trusted professional you can trust and whose experience you can trust, because there's a lot of conflicting information out there. So Thank you for bringing that up because that's a great point. Barbara, nice to see you.
Hi, Lisa. Congratulations.
Thank you.
I'm happy to be here, and I want to apologize for having my camera off. I am eating I'm looking at my lunch right now, and so I don't want to eat in front of you. So during the day, I'm the VP of Sales and Marketing at a small business called Guardian Energy Management Solutions, and we implement energy efficiency for municipalities as well as for large commercial and industrial customers. And then at night, I have a side gig, which is to represent Rodan and Fields, and it's an anti-aging skincare line. I am always trying to learn about the ways to reduce my tax burden. So I want to give the least amount of money to the government and still be abiding by the law. So Helen, any way you can help me with that, I do itemize. So if that helps in targeting your presentation, I really appreciate any tips that you have to reduce my tax burden. Thanks very much, and hello to everybody.
Hey, Barbara, nice to see you. Thank you for joining us. And I think that the sort of, and certainly there have been a lot of changes in regards to the, what's deductible and what's not, and the caps and the itemization piece, Barbara. So thank you for bringing that up. Robin Marquez, are you there, Robin? How are you?
Hi, I am here. I'm sorry, I don't have my Zoom on. I'm in the middle of a couple other things right now, but yes, I am a guest today. I'm not a member of the South Shore, but I am a member of the Metro West Women's Business Group. So, but I just thought this might be an interesting topic for me. I am a clinical owner recently of the past 2 years in an existing business, but I'm in the healthcare industry as well. I work with oncology rehab patients.
I'm on the phone.
I'm a physical therapist, and I focus mostly on breast cancer patients. And so this has been a really challenging time with COVID because, obviously my patients are high risk. And so we were open a portion of 2020, and then we saw our decline. So we ended up having to file and do some creative work where we got emergency loans, and now we're trying to work on some COVID grants. So trying to maximize on deductions as well. We've had to do a little bit of virtual, sessions. And so we are looking at what's deductible in terms of the expenses we've incurred with the new equipment we have to have, the PPE stuff, in order to see people in the clinic, what we can deduct, what we can't. And I do have a bookkeeper and we use QuickBooks. So, I'm on top of that, but I think really just seeing with these extenuating circumstances with COVID this past year, how that plays in and what would, make sure we're taking the full benefit of our, deductions and seeing what we can do with that. Obviously, we've had income losses, how do we maximize on those, I guess, and how do we, maybe put ourselves in a better position for moving forward into 2021 and starting as we, people enter people back in, and how we restructure, how we present our services, how we do, if we do anything different with our taxes. Where I am an S Corp. That's the other thing. Yeah.
So Robin, thank you for sharing that, because I think, I don't know, 2020, the year of the anomaly, right? So what, we had a lot of tax changes, I think, in the tax codes, and, there was, I even forget the name, job tax, whatever it was called back in 2019. Remember how long ago that was?
Yeah.
And then last year with PPP loans and forgiveness and all of those, SBA forgiveness loans and all of those other things. There's so much going on. And I think this is, if you ever wondered for a year to get a really good tax accountant, this is probably the year.
Right. And I do have a CPA, but it's even just, knowing, getting my stuff together to get for him too is a little bit,
Organization is huge, just to have everything ready, and any tax professional appreciates that. So thank you, Robin, for sharing, and thank you for joining us. I'm glad you're here. Suzanne Ryan. Okay, well, I see Suzanne, so maybe she is here. So what I'm going to ask everybody to do, because Barbara brought up a good point. This is a lunch and learn, people. So I'm going to ask everyone, first of all, to mute themselves while Helen goes through her presentation. And please feel free to turn your, actually, I'm going to ask everybody to turn their cameras off. So we're looking at Helen. I find it a little distracting when, so everyone feel free to eat. And we're going to let Helen move through her presentation, and then again, write some notes. And if you have a question, that would be great for the end. So Helen, I think I have turned on screen sharing. So why don't you double check that and confirm? Okay.
Yeah. Good.
Aha, we did it. Okay, Helen, I'm
Cool.
here when you need me.
Great. Yeah. Thank you, Lisa.
Thank you.
Welcome, everyone. Thank you for attending the presentation. I have summarized my presentation in 8 points that are highlighted for the changes. What the changes were is educational assistance, charitable contribution, medical expenses, economic impact payments, which is stimulus payment, retirement plan distribution, recontribution and loans. Also the RMD, which is required minimum distribution rules, repeal of maximum age for traditional IRA contribution, and then also other credits. In my next slides, following will be just the tax rate. So I'm not going to go through that because after the seminar, after the presentation, Lisa is going to send everyone my PDF copy. So you'll have the tax rate schedules. What I need to talk about is this standard deductions for 2020. There is $400 increase from $24,400 to $24,800 for married filing joint and surviving spouse. And then for a head of household, there's a $300 increase from $18,350 to $18,650. And then if you are single or married, if you file married filing separately, the standard deduction is $12,200 and increased to $12,400 in 2020. So you don't have to write all these numbers down because you'll be getting the PDF later. For standard deduction for those over 65 years of age and blind, it remains the same like last year. So there are no changes in that respect. Capital gain rate is also the same as last year. Gain on collectible is 28%. Gain on Section 1202 gains, which is small business stock, is 28%. Gains on uncaptured Section 1250 gain is 25%. And all other long-term gains, they have thresholds income limit from 15% to 20% if you exceed the thresholds. So for educational assistance, this is something new this year, effective March 27, 2020, and before January 1st, 2021. Any employer who pay principal and interest for the employee for employee loans, so the employer can take a deduction on their tax return, and it is tax-free for employees. So employee is not don't need to report that on their taxable income. So the limit is $5,250. The loan student loan repayment benefits and other educational assistance includes tuition, books, and other fees. So we're going to talk about charitable contribution next. So it is something new this year that if you don't itemize, you can take a maximum of $300 qualified charitable contribution on above the line on your 1040. The 1040 It's on it's on page 1 of 1040 and is on line 10B.
Yeah.
And also, of course, if you itemize, you can take, you know, non-cash deductions, like, you know, what you used to take, what you used to deduct. So the limitation used to be 60% of your AGI, your adjusted gross income, has been increased to 100% of your AGI for cash contribution. And also for food contribution, it's been increased from 15% of your AGI to 25% of your AGI this year. So a lot of advantages for charitable contributions. So another big change is for medical expenses. If you have a high deductible insurance, health insurance, you might have you know, health saving account. So you can take reimbursement from your health saving account for non-prescription drugs and medicines starting this year. Also, you can take like the over-the-counter medicines and drugs, which also includes amount that you pay for menstrual care products like tampon, pad, liner, etc. So regarding economic impact payment, which is stimulus check, so everyone by now who has already received the first stimulus payment, if you qualify, of course, there is income range for merit filing joint. The income range is you do not exceed 150,000 for head of household, do not exceed 112,500, and also for single 75,000. So you might have received $1,200 for individual. Merit filing joint is 2,400, and additional 500 for each qualifying child. On your tax return, there is a line that says credit, and it's on page 2 of your tax 1040, and it is on line 30, recovery rebate credit. So if you have not received your stimulus payment, you can claim the credit on that line. But if you have received them, so the credit will be 0 if you receive a full amount. And if there is a difference that when the tax returns calculated result came out that you should be getting more, then you get the addition on your tax return. But if situation changed in 2020 and then you receive more than what you're supposed to, you don't have to give it back to the government. So there is the second stimulus check of $600 per person, also restricted to the range of income that I've just mentioned. The second stimulus checks were distributed in December. So the Congress is also now talking about giving us a third stimulus package, but we don't know when we're going to getting it. I think this Congress is still debating on how much is it. Originally, I think it's like $1,400 for single. So for small business this year, the programs allowed small businesses to apply for PPP, Paycheck Protection Program loan, with 0% interest of up to $10 million. However, the businesses that apply must have less than 500 employees, and they this also qualify for individuals who operate as sole proprietor, whether with or without employee, or if they are independent contractors. Business who receive the PPP loans they must, the loans must be available to cover payroll and payroll taxes, health benefit, rent, mortgage interest, and utilities. Your loan must be spent on whatever I mentioned before, but if you don't, then you are not forgiven. You have to pay the loan back over eight weeks after you receive the loan. Originally, IRS, under IRS ruling 2021-2, said that the expenses pertaining to your loan that you apply for are not deductible. However, they changed it for under Notice 2020-32, the Consolidated Appropriation Act 2021, provide us that all the expenses pertaining to the forgiven loans are now deductible. Next is, we'll talk about retirement distribution. So anybody who has taken out to the maximum of $100,000 loan, if they are affected by coronavirus, so this they call it coronavirus related distribution, you are allowed to repay the loan over 3 years, or you are allowed to, if you're not planning to repay, you are allowed to recognize the income over 3 years. The 10% early withdrawal penalty does not apply here. So you're not penalized. You don't have to pay 10% when you take the coronavirus related distribution from your retirement plans. Taxpayer can also contribute the money back within 5 years, so you don't have to pay any income tax, and they are considered as tax-free rollover. Minimum required distribution. So when you reach previously age 70 and a half, you're required to take a minimum distribution from all your retirement plan. However, the Secure Act has changed the age from 70 and a half to 72. So you don't have to take the money out when you're now 70 and a half. You can extend it until when you are 72 years of age to take minimum distribution. So under the CARES Act, no minimum distribution is required to distribute this year. The next RMD will start 2021. So for people that are over 70 and a half and are still working, used to be, they don't allow people over 70 and a half to take out, to contribute on IRA, traditional IRA contributions. Now the law has changed. So if you are working, if you have earned income, no matter you're over 70 and a half, or you're 80 or you're 90, you're still allowed to contribute into your IRA as long as you have earned income. So for 2020 IRA limit, this contribution limit is the same as 2029. It's also just $600. And also, if you're over 50 years of age, it's $1,000 in addition, which is the catch-up contribution. So I'm going to talk a little bit about other credits, such as adoption credits. So adoption credit has been increased from $14,080 in 2019 to $14,300. And also there are also change in the modified AGI, over 214,520, So once you reach 254, 520, the credit will disappear. So that phased out. Lifetime learning credit, also the phase out adjusted gross income is between 118,000 to 138,000. The for couples, for married couple join, single is 59 to 69, within the range. Residential solar credits. So it fell from 30% to 26% in 2020, and it's going to further drop to 22% in 2021, this year. Standard mileage also dropped a little bit from 58 cents to 57.5 cents per mile. Medical travel mileage also dropped from 20 cents to 17 cents a mile in 2020. Charitable driving rate stays at 14 cents per mile. Also, there are changes in long-term care premium. So you can take the deduction, but the amount is limited to age. Like if you are 70 years or older, the write-off is $5,430 per person. If the filer is 61 to 71 years old, can deduct $4,350. And if you are 51 to 61 years of age, can deduct up to only $1,630. And if you're age 41 to 50, the maximum amount you can deduct is $810. And for 40 and younger, it's only $430. So people are like, you find people, less and less people are going to get long-term care insurance, right? Pam will tell you that, I guess, because you know, sometimes you pay for it, but you don't. If you don't take the claim, you don't need the claim, then you lose it. So people are like more geared towards life insurance with the rider, right, Pam? So for itemized deduction, actually, the law stays the same when the law was changed from the Tax Cuts and Jobs Act. That, you know, for taxes you can take only $10,000 with, you know, all your income tax, real estate tax when you itemize. Also, you can take, like, say, mortgage interest. These disaster losses for federal, you can only take the deduction only when it's federally declared disasters. Gift and charitable contributions remains the same, except this year they add the $300 on the above the line deduction if you don't itemize. Due to limitation of the $10,000, so a lot of people are using standard deduction now instead of the itemized deduction. The new tax law, like personal casualty losses, are no longer deductibles from the Tax Cut and Jobs Act. So effective from 2018, miscellaneous item deductions are not allowed anymore, like, you know, investment expenses, tax preparation fee, hobby related expenses. This is just a reminder for everyone. Qualified business income deduction. So whoever has a Schedule C or whoever has partnership S corporation, they can take an extra 20% of taxable QBI, qualified business income deduction, on the tax return. There are three limitations that we have to pay attention to. Is 20% of your income limit, the W-2 wages limit, and also if you are an SSTB, which is a special service trade or business limits that are for, like, say, if you are an accountant, if you're a lawyer, or if you are an investment advisor, you belong to SSTPs, so you won't get the QBI deduction. Massachusetts individual income tax. So for Massachusetts, there are changes that Massachusetts adopts to federal law, but some part Massachusetts does not adopt to Massachusetts to federal laws. So this year, Massachusetts income tax rate has lowered from 5.01% to 5%. For tax rate for short-term and long-term for sales and exchange of collectible remains the same, 12% after 50% deduction. Interest expense deduction, beginning 2018, business interest deduction was limited to 30% of adjustable taxable income, adjusted taxable income. And then, you know, any excess is carried over to the next year. The CARES Act amended in 2019 and 2020 to increase the limitation to 50%. And allows taxpayer to elect to use either 2019 adjustable taxable income to calculate the limitation. So Massachusetts adopt the current tax code for personal income tax with business interest deduction on Schedule C. Also, regarding medical expenses, so taxpayer allowed to deduct medical expenses on if you are itemized deduction on federal adjusted growth federal tax return if your medical expenses is exceed 7.5% of your AGI. So the deduction, if you do not itemize, you don't get the medical deduction on your Massachusetts tax returns. So loans from qualified employer retirement plan, Massachusetts also adopt the same law as federal, as I have just mentioned before when we were talking about the federal tax deductions. And small business loan. For the PPP loan, Massachusetts does not adopt these changes for the purpose of personal income tax. But for the Massachusetts corporation, Massachusetts adopts the federal income tax law. So for individuals, if you have a PPP loan on your schedules, you are Schedule C, you got a PPP loan. So the loan is not taxable on your federal, but it's taxable in Massachusetts. But for if you have an S corp, or if you file 1065, so whatever amount was forgiven on the federal is forgiven on the Massachusetts corporation tax returns. Health insurance. So everyone knows Massachusetts is the state that require any adult over 18 years of age to acquire health insurance coverage. If you don't, the penalty will be the monthly penalty imposed on individual based on half of the minimum monthly insurance premium, which the individual would have qualified through the health connector. For circuit breaker, taxpayer who are over 65 years and older, if you own or rent a residence, and if your the rents that you pay over 25% that constitute real estate tax payment, you can claim the circuit breaker tax credit, and for those who own property also. So the amount for circuit breaker tax credit is $1,150, and the your real estate tax and your rent plus your the rent that belongs to the real estate tax portion must exceed 10% of the taxpayer's total income. And also limitation includes the fair market value of the property, the assessed value of the property, not exceeding $484,000. And in 2020, taxpayers' income, if you are single, taxpayers' income must not exceed $61,000 to claim. Head of household, $76,000, and filing joint return, your income cannot exceed $92,000. Your total income, which includes tax exempt income, tax exempt interest income, etc. So Massachusetts employer provide parking, transit pass, or commuter highway benefit exclusion is $270 for employer provide parking, and then $140 for combined transit pass and commuter highway vehicle transportation benefits. Also, Massachusetts tax implication on COVID-19 pandemic. So if you work because you have to work at home from home due to COVID-19. So if you generally perform your service in Massachusetts and you continue be taxed as Massachusetts personal income. And if you work, if the employee engage in an outside location in Massachusetts, even though you work from home, you're still be taxed as Massachusetts income, but you are eligible to claim a credit of taxes paid to other jurisdiction. I think that's all I have for the presentation. Is there any question, or I might not have covered everything that Schedule C or a small business owner.
So Helen, let's do this. Let's stop sharing your screen.
Mm-hmm.
So maybe we can bring everybody back. All right, there we go. All right, we are repopulating here. Okay, so everyone, if you would like to go ahead and unmute yourselves. I know there were a couple of you I forcefully muted, so sorry for that, but it took me a while to figure out how to do that, just for the record. So welcome back, everyone. Helen, thank you. That was amazing. And I know I jotted down, Lynn Feingold, welcome. Nice to see you. So Lynn, if you have not, please throw your contact information into the chat. I'm going to try to save that chat and share that with everyone else later. So I'm sure people have questions. So maybe I'm happy to, why don't you raise your hand? I don't know. And Helen, go ahead and if someone has a specific question that you might be able to answer. And again, everybody, I am going to share the PDF of the presentation, because there's certainly a lot of amazing information there. So if anybody has a question, anybody like to ask a question of Helen?
Oh, Barbara?
I've written down a few questions.
Uh-huh.
And, so I may be missing some key elements here, but I know you know about them. So at one point when you were talking about the changes for IRA contributions,
Mhm.
I was wondering, do you have to be employed to contribute to an IRA? So say for,
Yes. You have to have earned income in order to contribute.
okay, earned income. Okay. All right. And then what is the lifetime learning credit? That.
Lifetime learning credit, the amount is the same as last year. I think it's $1,500. Same as last year. Yeah.
What is it
So,
exactly?
so if your kids in college, and if they are like a 4-year qualified educational program, when your kids enter college the first year, you can take like the lifetime educational credit, and then after that then you can take the American opportunity credits.
Okay, so this is for if you have kids in college then?
Yes.
Okay.
Yeah.
Thank you. And then can you explain what the mileage allowance for medical travel is?
Like say for instance, if I have to go to the hospital and I drive my spouse to the hospital, so those are the mileage that I can take as deduction on Schedule A.
Schedule A.
Yeah.
Okay. And then one last question. So when you were talking about itemized deductions, which is what I do, you talked about a $10,000 limit, and I wasn't familiar with that. I don't.
So the Tax Cuts and Jobs Act started that. So for your total income, like your state income tax that was withheld during the year, or you pay estimated taxes during the year for your Schedule C, the total of all those taxes plus your property tax or any excise tax that you pay, or sometimes there are sales tax that are greater. If your sales tax that you pay is greater than your income tax, the total of all those taxes added together, you can only take $10,000 as deduction.
That's a big change, right, Helen? It used to be,
yes.
yeah, that's a huge change. So that was a big one, because it used to be that people, there was a standard deduction, right? And then people itemized, right? If you had a Schedule C, you go ahead and itemize.
Yeah.
But what the Jobs Tax Act thing did was it said it's only $10,000. That's your property tax. That's the interest rate on your mortgage. That's your financial. Those are your charitable contribution. So that was a really, really big change that hit a lot of sort of middle earners pretty heavy.
Right, but there is one advantage, because you know how when you work, when you do your taxes, might be alternative minimum tax. Alternative minimum tax add back those taxes which created alternative minimum tax, which is higher than your regular tax rate. So because that it was limited to $10,000, so you don't, a lot of people don't have to pay alternative minimum tax, meaning on a higher tax rate.
And what year did this go into effect?
I think it's 2017 when the Tax Cuts and Jobs Act was started, put into law, made into law.
Okay, great. Thank you.
You're welcome.
Helen, I'm going to just chime in on one thing to help with Barbara's answer. And this is something that very few people understand. But if you are contributing to a retirement account, whether it be a 401k, for not an IRA, I'm talking about like an employer retirement account, you're considered to be an active participant in a retirement savings account. You cannot contribute to a deductible IRA.
Right.
If your income as a single, this is for 2020, by the way, if your income as a single filer is anywhere between 65 and 75,000. So if you make more than $75,000 a year and you unknowingly contribute anyway to an IRA, even though you're contributing to a 401k,
Mm-hmm.
you are going to get in big trouble if
Well,
the
you can
IRS
do
ever
as
finds
a
out. They will
non-deductible.
penalize you and they will make you pay back taxes.
Right.
Now, and unfortunately, I had a client run into this very situation. She's single and she neglected to tell me that she was making a boatload of overtime. And she was contributing, because she's over the age of 50, she was contributing the maximum of $7,000 for 3 years.
Oh, wow.
And her tax preparer, the first year, didn't pick it up. Okay. Tax preparer in third year picked it up and alerted her to it. Unfortunately, he went ahead and filed her taxes anyway before we were able to undo that $7,000 contribution. Anyway, it cost her a big penalty. And it was a nightmare for me to undo the whole thing for her. So beware of those rules, because that's a lot of people just don't know that. I was just having a conversation with, just this weekend, I should say, with my nephew's fiance, who was asking me about contributing to an IRA. And also she's contributing to her 401k. So my first question was, do you make more than 70? Well, it's actually this year, it goes up to 76,000.
Right. Yeah.
Okay. So, and the answer to the question was, yes, I just got a raise and now I am making more than 76,000. I said, did you make more than 75,000 in 2020? And she said, no. And I said, okay, you're good, but don't contribute anything this year.
Yeah.
So it's a tricky thing.
Yeah, it is.
That you got to be aware of.
I have a question. Does that only apply if you're contributing to an employee account, like a 401k? Because like I have an IRA because I no longer work for a corporation. So like I should be fine contributing to my, because I'm not doing anything
Correct.
else.
If you're not contributing to any kind of an employer, or if you don't have your own, your own personal 401k.
No, we rolled it over
401k,
to an
nothing
IRA.
like that. Then you can, $6,000 or $7,000 with the catch up if you're over 50.
Yeah.
Okay.
Can I just ask, is that the same as, I think the one, I work for a college and I think it's called a 403B?
Yes.
That's
Yes.
you're
Yeah.
saying, so then I
It's the
can't
same
contribute
thing.
to my IRA.
Correct.
Correct.
Okay.
Oh dear.
You
And
can
you roll it-
contribute to it, but you can't deduct it.
Yeah. You can file 8606 for non-deductible IRA. Yeah.
Correct. And if you're doing that, and Helen and Laura would agree with me on this, you should never commingle pre-tax and after-tax, meaning pre-tax and non-deductible IRA. So if you, Sherry, if you have, historically, let's say you have had an IRA that it was all pre-tax money, okay, that you were able to deduct. If you still want to contribute to an IRA, you should open up a second IRA and put your after-tax non-deductible contributions into that. Because as I always explain it, if you commingle those two, okay, fast forward down the road, when you go to take the money out, it's like putting the vanilla in the cake mix. Once it's in there, you can't get it out. So there's not an easy way, unless you're going to keep meticulous track of, what you put in pre-tax versus after-tax. So my advice is never to commingle those. Make sense?
Yes.
Okay.
Can I just ask for a clarification? Because when Helen and Pam, maybe you can correct me on this. I thought that any kind of earned income was acceptable to put into an IRA. So if I have a small business and I don't make more than the maximum, as long as I earned the money, I can put it in. So I don't actually have to be employed to contribute to an IRA. I can be
No, it has to be earned income.
This has to be earned. Yes.
In other words, when you file your taxes, you report that income.
Right.
That's earned income.
Yeah.
Not as opposed to interest income, which isn't considered.
Right. No, I get it.
earned.
No, it's just that I thought when Barbara asked the question, she says you have to be employed, but no,
She
you
did
don't.
ask that question.
You can be self-employed as long as you are earning the money. It's
Correct.
It's eligible for a contribution.
Correct.
Correct. Yeah.
So
I'm sorry, I was
Whatever.
just going to say, thank you, Deb, for mentioning that taxes make your head hurt, because they make my head hurt also. So thank you for
True.
thank you for the thought bubble. Go ahead, Steph, you had a question.
Yes, regarding medical travel. Okay, my life is, I drive from Massachusetts to take parents to doctors in New York State, and also now it'll be New Jersey. Is that mileage deductible from home to? Yes,
Yes.
good. My theme song is on the road again.
But don't forget your medical expenses. The total of your medical expenses has to exceed 7.5% of your AGI in order to allow you to deduct medical expenses on Schedule A.
Okay.
And does that include the mileage?
Yes, that includes.
Okay, all right.
So I had a quick question. I saw in one of the things that you had noted, Helen, was that the mileage rate has dropped. So I guess I'm wondering, Aileen, and maybe you can jump in on this, is QuickBooks going to do an automatic update to when I run my P&L at the end of these? Is it going to know automatically that my rate has changed, or do I have to manually go in and change that?
Oh.
And then are you going to answer that, or can I?
Yeah, I actually don't know the answer to that.
Okay, for QuickBooks, if it's QuickBooks Online help you to track your business mileage, but they do not calculate your business mileage deduction on your Schedule C.
Right.
So when you prepare the tax return, you have to punch in your business mileage on your business use of vehicle in order to take the deduction. So the tax software automatically, takes the reduction. So yeah, automatically.
So it's interesting, Helen. I'll need to look at that. For anybody else who, like me, is using QuickBooks Desktop, I do not use QuickBooks.
Oh, desktop. I see.
So on desktop
doesn't track your business mileage.
You can track it. You have to track it manually. You have to go in and track it by day, by mileage, and all of that. And then at the end of the year or at the end of the month or whatever, when you run a P&L, it will show you what your mileage is. But I wonder what rate it is using.
Oh.
Right. So that's a question. So that's a note to self to check. And I'm wondering, is there an automatic update to QuickBooks that is updating that sort of thing if you're using a desktop version?
Well, QuickBooks is very good with updating.
Sure.
Yeah.
Okay.
So I'm sure they will.
I love your optimism, Helen. That's what I love.
But I would imagine, though, Lisa, that if you're using the desktop version, you may have to manually or go in and deliberately get the update versus the online version. Yeah.
So that's definitely, they keep trying to get me online, Deb, and I've resisted. So let's see how that is.
Oh, I don't blame you. A lot of my clients are reluctant to go online because they are afraid that their information is, up there in the cloud somewhere, people can access or something.
I have to say, Helen, for me, that's not my biggest challenge. I think it's, I don't know, I've been using desktop for a very long time, and, old dogs, new tricks and all that sort of thing. So, so everyone, thank you, Helen. That was amazing. Anyone else have another quick question they want to ask Helen before we sign off? I know, lots of information. So again, thank you all for joining us. Helen, that was amazing. You know what, Lynn Feingold, you didn't have an opportunity to introduce yourself to the group, and I know you've got your new business. So why don't you take a minute and talk to us and tell us about your business, and then we'll wrap it up.
Well, thank you very much. I apologize for being late, but my vet was closing and I had to go get kitty cat medicine before they closed. So it was like reality, suddenly I've got to get this. I can't wait. So anyway, but I'm sorry I was late and I missed a bit of your presentation, Helen, but what I heard was fantastic. So yes, I've just hung up my shingle and signed my first client as a virtual assistant. And yeah, right. I'm very excited. It's terrifying. I mean, no, it's really good. It's good. But it's exciting, when you take a step into something new like this, right? And I'm building the bridge as I walk on it. So I'm very excited about this possibility. So my spiel is that do you ever wish there were two of you? Are there things that you just don't get to every week? And would it help you if I helped out, 5 or 10 hours a week? We should talk. How can I help you? Okay. So I put my contact info in the chat. Please do share anytime, I got my first client through a referral from a group just like this. So referrals do work, and please do keep me in mind. And I'll keep all of you in mind too.
So Lisa, I have a question. So everyone put in their contact, but how do I pull the contact out?
Good question. So I saved the chat. So when I send out the follow-up email, which I will this evening, I promise, I will attach this chat.
Oh, great.
And you will be able to see all of this information. And everyone, I'm also going to thank you, Helen, for all of that amazing information. I'm going to attach
My
the
pleasure.
PDF of the content that Helen shared so that everyone can take an opportunity to sit back either with a glass of wine or a cup of tea and read through.
Yeah.
You choose, Deb. I know what I'm choosing. So go through that. And great. And again, this is an opportunity for everyone. If there's someone here that you met, I mean, I know everyone wants to talk to Helen now, of course, and Lynn, of course, and Laura about it. The whole thing about retirement accounts is it's tricky. And it's and so go to an expert who knows what they're doing. I know your brother-in-law thinks he's an expert on all things, but that doesn't make him so. So go to an expert. So all you have to do is go to the directory of the SSWBN and see the amazing people that we have in this network. And if you have questions about IRA, all of us are always willing to answer a question. So reach out and use that as a resource for sure. So look by the end of the day for those for that email from me. If you have not received it, please be sure to check your junk mail and reach out to me directly. You can always do that at info@sswbn.org, or you can email me at lisa@yourorganizedlife.biz, and I'll be sure to forward that on, because I know sometimes things get filtered out because that's what email is supposed to do. So thank you all. Thank you, Helen. You were amazing.
Thank you, Lisa, for organizing.
That was great. And look forward to seeing you all later this month at our focus chat, talking about how we're going to close some business. We're going to see Aileen next month talking about bookkeeping and all of those other very important things. So thank you all. Thank you for coming today. Yeah. And I look forward to seeing everybody soon.
Yep.
Thank
you
you.
for your
Bye. Take care, everybody.
Thank you.
Thank you.